Welcome to the Anton Stentner podcast. Today, we're asking the question, will home prices keep dropping? Now, my first thing is, I didn't know home prices were dropping.
Yeah.
What's going on, Anton?
Yeah. I went full data nerd, and I wanted to kind of dig through this idea of like tariffs, the economy, unemployment, inflation, the Federal Reserve interest rates, and then how does that relate to real estate? But I think most people are missing right now, the Seattle Metro, fourth quarter sucked. Prices went down. And Resi Club Analytics just released something that showed out of the 300 major, cities and metros, 100 of them are having some type of price decreases.
Around the country?
Around the country.
Wow.
And it's not, they're not huge, but in some areas they are, like in some parts of Florida. And so we kind of wanted to get through this idea and build a framework for what's been happening. And here's the idea. The Supreme Court literally just nuked Trump's tariffs. The Fed is divided, and Washington State's our inventory right now is up 26%.
Wow.
The Trump administration immediately responded with a 15% tariff, the overnight surcharge. And the media is telling you the economy is stagnant because of job revisions, where we just erased 862,000 jobs. So you're waiting for certainty, but if you're waiting for certainty, you're gonna lose money. So in this video, we're gonna basically go through the exact chain of events from what happened in these DC courtrooms to mortgage rates, and how we basically have this real estate transmission chain, this chain of events that's happening that's creating massive opportunity in a buying window right now that I don't believe is going to last. And then stay tuned, because later on, I want to prove to you how I believe the Fed has already won the fight on inflation. They just don't want to admit it. And I'm Anton Stentner, and we like to talk about Washington State, real estate, the economy, finance, business. We sell a bunch of homes here in the Seattle Metro, and we bring to you this podcast once a week. So please hit that subscribe button and follow us along on the journey while we go through today what is the real estate transmission chain that's happening that's affecting your pocketbook right now.
Yeah, and then obviously affecting home prices, right?
Obviously affecting home prices.
And it starts with the first topic. The Supreme Court struck down Trump's tariffs. And what was his response? You should explain to people that might not be like up to date with it, where the Trump tariff started, why he did it, where it was coming from, and then fast forward to today, and why the Supreme Court striking it down is a big deal.
Oh, massively big deal. So the Trump administration, he said, my favorite word is tariff. And then he later just said, well, that's my second favorite word. But what Trump likes to do, if you ever read his book, The Art of the Deal, he likes to negotiate. He is a negotiator. So they use tariffs as a massive negotiation tool, and they're to bring manufacturing home, to change the economy, to get a bunch of money from our allies, from other countries, to make America great, to bring manufacturing home. And part of it, they started, putting under national security. What's really interesting when we start to think about this, Benji, is this is exactly what we said was going to happen just a few videos ago in the Greenland video. See, everyone thought that he was framing up Greenland because it was a great piece of real estate. It's going to be the biggest real estate deal ever. And then all of a sudden he starts talking about national security. It's because he knew he was going to lose the IEEPA tariffs before then. So they were changing the rhetoric before it actually happened. So what is the IEEPA tariffs? The IEEPA tariffs are they're supposed to be used emergency powers tariffs. What the Supreme Court just decided, the Supreme Court said, hey, this is unconstitutional. You don't have the power to do it. It's illegal. Congress is the only one who has the power to do this. And what happened was, as soon as they enacted that, the Supreme Court basically said 6-3 that President Trump exceeded his authority under the International Emergencies Economic Powers Act to impose broad tariffs, aka the reciprocal tariffs, and the court upheld the president can't do that and only Congress can. So literally, direct response. Next day, he says, all right, there's a 10% tariff on everyone. And that was using Section 122. And then literally that night he got bored. And so all of a sudden on social media, he's like, oh, by the way, it's 15%, and just raised it again. So I got to make one of my biases clear. Okay, so whenever we're talking about data and numbers and facts, I want to make sure that you guys understand my bias too, so then you can make your own personal decision. I'm like 60% anti-tariff and 40% pro-tariff. The reason I'm anti-tariff is tariffs show up as a tax on consumers and a tax on business and a drag on the economy, and the economy is already a little bit beat up. Where I'm pro it is I'm very pro it from the national security point, from the bringing manufacturing home.
The fairness point too?
From the fairness point. I love some of these ideas, but I don't agree with the implementation. I felt like we went at it with a blunt instrument and just started playing whack-a-mole with a giant hammer instead of being more precise about what we should be doing. Trump has built us a tariff layered cake. Okay. So now, once again, in the Greenland video, we started proposing the idea that he was going to say this is about national security, because if the whole administration started changing their rhetoric beforehand, then it's easier for them to get these passed and through. So the base layer, the temporary ones, are the Section 122. These are global surcharges. They're a quick replacement, but they're limited to 150 days. They're the durable section layers, okay? So this is the slower, they require investigation. They're potentially longer lasting. These are the Section 232, AKA national security. So if it's framed as critical for national security, we can use the Section 232 tariffs. Now they have to go through this big giant study. It literally takes like 100 plus days. They could rush it through. Then the president has 90 days. Well, as he puts these other ones into effect, he's got 150 days.
Oh, because he started doing them before?
No, because he just instantly did them.
Oh,
so as soon as they declared IEPA, he doesn't have the power. Now he moves to Section 122. There's the base layer. I have 150 days. Oh, during that, I'll quickly cram through the 232s for national security. And then the last one, which is the targeted country practice layer, these also require investigation, and they're also adjustable. This is the Section 301. This is actions to rebuild pressure or particular countries or practices beyond temporary global surcharges. The difference is these tariffs, once he gets them in place, can go on a lot longer. So you use...
Before they get struck down again?
This is why he's deeming it as part of national security. This is why they're framing it in certain ways. This is why we were talking about it. We were telling you, the subscriber, this was happening before it was coming. We got the receipts on this one. What's very interesting, though, is what's going to happen with the tariff money that was already collected. So the tariff money that was already collected, obviously that's going to go to the courts, and obviously it's going to be litigated. Something interesting to think about. I don't know if they should give the money back. So even though I think in litigation, like they could win, but that business already passed that cost on to the consumer, and that business already made profit. And so if we just give the money back to the business, because the IEPA tariffs were illegal, that business, are they going to change and lower their prices?
If they get the money back?
Yeah. No. See, businesses never lower their prices.
But I don't know. Maybe some will.
No. They call it price inelasticity. Once the consumer proves they will pay the price, the business just makes more profit.
Unless people weren't paying the price and bought less, right?
Correct, unless the demand went down. Have you seen the craziest example of demand going down lately? Like, neutrally, did you hear about this? Like what Doritos had to do?
Shrinkflation?
No, not shrinkflation.
What?
Did you hear about Doritos? Okay.
No, I haven't.
So what's one of the really big things that RFK has been doing?
Red dye 21 or whatever. Getting rid of just
The red 40, is that what it was?
red 40. Getting rid of artificial ingredients
Getting rid of
high
artificial
fructose-
ingredients.
high fructose corn syrup, maybe.
Getting America healthy.
yeah.
Right?
Maha.
So, what did they do to SNAP benefits that we're paying for pop and chips?
Great. I heard about that.
That's what we're talking about. They cut back SNAP benefits for soda and chips. And so this goes to show you how much SNAP benefits we're paying for it. Doritos immediately had to drop their price by 13%.
Oh, dang.
Okay.
When was that?
That happened in the last 2 weeks.
Oh my gosh. Crazy. Well, yeah.
So that's the only way that you see massive changes is when that demand goes away. That
By
demand,
the way, can you give me my chips initially?
that demand was massively artificial, though, because that was the government creating that demand. It's a great example of when the government gets involved in anything, it just massively jacks up the prices.
That is nuts. But I mean, I guess, I always wondered about that because you can use your SNAP benefits at like farmers markets, which is great because you're getting a lot of fruits and vegetables.
Absolutely.
And I think they even make further discounts for people that are using it. But yeah, at the grocery store, I've been eyeballing some of these grocery carts of people using it. The reason I know it is because when you're going through, there's like a certain card they used for it, right?
Yeah.
Not that I'm staring at their cards or anything. That's just like the lady's explaining it to her, right? Like, oh, that's how you use your card or whatever. Yeah, sometimes you do see some unhealthy things. I have no judgment. People should be able to buy whatever they want. But in this case, because of Maha, because of RFK and his push for healthy eating habits, they're putting this into policy for the SNAP benefits. And then that makes sense that Doritos would be one of those companies that would get hurt because ultimately that's like some of the cheapest food you can buy.
Yes, exactly.
But it's even cheaper now, which is crazy just because now they don't have that source of income to be able to buy those.
Subsidy from the government.
So that means that people are buying something else. Yeah, that's crazy.
So, listeners, ask yourself this. What should the government be getting out of because they are causing the market to overcharge? Housing, banking. I mean, just go right down the list. All right, I want to flip back to this. So we're talking about tariffs, 40% pro, 60% con, because I'm more of the free market person. But the problem that I have with just tariffs in general is there's data that came out, and we believed this was true, but now we have the data to prove it, that it's really hurting the U.S. consumer. So the Federal Reserve published on February 12th, stating 90% of the economic burden for the U.S. tariffs fell on the U.S. consumer. I mean, so basically we're like taxing our own people to pay for these tariffs.
yeah.
I don't like that. I'm so against taxes, and if you saw the income tax video, you can see we're anti-tax. Then Kevin Hassett in the Trump administration, he literally attacked the Federal Reserve for this paper in a CNBC interview. He called it an embarrassment, the worst paper I've ever seen in the history of the Federal Reserve, and suggested the researchers should be disciplined for what he described as partisan, low-quality analysis that contradicted the administrative's view on tariffs, benefits to consumers, and don't impose significant domestic costs. He had to later walk that back because of the storm that he got for saying that to the Federal Reserve, for threatening the Fed's independence. But it goes to show you that the administration is willing to put out a lot of rhetoric to get their point across. Other people, though, came out with the same findings. The Kiel Institute found 96% of the tariff burden was passed on to the U.S. buyers, with foreign exporters absorbing 4%. And they based this on 25 million transactions valued at nearly $4 trillion. The Yale Budget Lab said that the average household is spending $800 per household, 3 times higher than was before because of the tariffs. And NBER found that 94%, so this 94% and 96 basically comes up multiple times. Lastly, the Tax Foundation said that they believe that 2025 tariffs amounted to an average tax increase of $1,000 per U.S. household. Now, if these tariffs are inflationary, why did our GDP just come in at 1.4%? And the answer involves the government shutdown that most people have already forgotten. And just to kind of rehash where we're going with this, I've got to get back to the first page of my notes. Tariffs into the economy, into unemployment, into inflation, into the Fed, into interest rates, and then how all of this ties to real estate and home prices.
Well, let's just take real quick before we go into the GDP going in lower on the reports. Just tariffs alone could be hurting the average American enough to where it would make it harder to buy a home because
Correct.
you can't qualify for a mortgage, correct?
It's putting, so according to two of these, it's costing the average home between $800 to $1,000 a year. Okay. So that's a loss in disposable income. But more important than that, I think, is it creates the turmoil. So
The uncertainty.
Bingo. Buying a home is an emotional transaction. We only do that emotional transaction when we feel okay, good, and secure. When tariffs bouncing around and us having verbal spats with countries and threatening Greenland, that makes the U.S. consumer uncertain, and that uncertainty causes them to drag their feet and not buy and sell real estate.
Can I ask you one more question?
Yes, sir.
I always look at the grocery store prices. I look at Costco prices,
Yeah.
and I document them every single week inside of my shopping vlogs. And one thing that I've realized, and I think a lot of the comments in my videos say this, that tariffs have finally kind of settled, and now you're seeing it be represented in the prices of goods.
Yep.
So would you say that real estate has kind of followed the same kind of timeline? Now we're seeing the effects of those tariffs in the real estate market. And that's why in fourth quarter, at least in the Seattle metropolitan area, we're seeing home prices go down.
Correct.
Because it's finally sinking in. There's a lot of people who are already on their way to buying a house way before the tariffs started. So they were kind of on track.
Yep.
Maybe they even looked at houses. Maybe they put things. Would you say that's happening right now? Because it just seems like too much of a correlation.
That's almost causation. So beyond correlation, those events are tied together. So if you think about Washington State as a whole, Washington State as a whole is an economy that is more impacted by tariffs because of Boeing, because we're a deep water port. We're one of the 3 deep water ports, because of our tech sector. We have tariffs have a higher influence on our local economy than they do like somewhere in the Midwest or Utah, for example.
Yeah, and that includes also home builders probably.
That includes home builders, that includes lumber.
Contractors.
Yeah, electrical conduit. You wouldn't believe how much the wiring that goes into things just costs right now.
All right, so now we're going to talk about GDP coming in lower.
Yeah.
Well, you should tell us what GDP means and how that relates to lower home price, and more specifically government shutdown.
GDP is our gross domestic product. It's a way to measure the output of the United States. You want the GDP to be higher than 2%. That way the economy is growing at a good clip.
And that's kind of how they determine the health of economy
Correct.
and a country.
Yes, exactly. So the conservative forecast for GDP for Q4 2025 was 2.9. The actual that came in was 1.4.
For the fourth quarter or the whole year?
Fourth quarter 2025. That gave the markets a head fake. The markets weren't anticipating that because that's significantly lower. That's a massive miss to the downside. And the headline number suggests that the economy hit a brick wall. But what was more nuanced was the federal government was shut down for 43 days. So that paralyzing of DC during that process showed up in our gross domestic product.
Oh, it's because consumers, a lot of them are working for the government. They don't have the government, so they're spending less. Was it that, or is it more across the board?
So what you said is a portion of it. The government doesn't spend when they're shut down. So the government's
Oh.
not buying stuff and writing bills. And I mean, so you missed 43 days of the government burning cash.
And that's like kind of related to like the SNAP benefits being
Correct.
like contracted. But what you're saying is government shutdown is not good.
Anytime the government shuts down, it shows up and has ripple effects in our economy. Don't let the politicians pretend that it doesn't. So this shutdown acted as like this massive anchor on the headline growth, but its effects were highly localized at the federal level. So government spending plummeted 5.1%. But the federal component went down 16.6% during that same quarter because, once again, the 43 days were missing. Interestingly, though, the state and local government spending actually grew by 2.4% during the same period, showing that this issue was really just at the federal level. So what it means, though, is that 1% swing will actually just show up because just because the government didn't spend the money for 43 days, once the money is allotted, it's still burning it. So they just come through and cram it through later, which means it'll show up in Q1 of 2025. So Q1 will show up hotter than it was anticipated with kind of that bounce back effect of the GDP that wasn't there before. What I don't like right now is we keep talking about GDP is good. But and the government's telling you everything is okay. But I feel like household and personal GDP is beat up. And let me explain what I mean. Every person I talk to right now, it doesn't matter the age, doesn't matter the income bracket, doesn't matter if they're from Washington or outside of Washington. They feel pinched based on affordability.
Everybody?
Everybody.
Wow.
Even the people who you would say they're the ultra high net worth individuals who are what you would consider to be the ultra rich, the mega wealthy, they don't necessarily feel the same pinch, but they are pinching regardless because the economy is pinching. So they naturally slow down their consumption. They're naturally pulling back too. And so the reality of this is, even though that GDP was stagnant, we had private domestic final purchases grow at a healthy 2.4%. And Fed Governor Waller, he urged investors to look past the GDP headline and to look at the PDFP, which is the private domestic final purchases, because it strips out the volatile noises of inventory, net exports, and government spending. So that was actually up. But the problem is, one, the consumer isn't feeling it themselves and they're feeling it's unaffordable. Like if you feel it's unaffordable right now, just type unaffordable or pinched into the comments. Second, tech is our only lifeboat. And that non-residential investment saw a 2.6% increase, but that was almost entirely driven by tech and the AI sector. So we have this narrow part of the economy that is keeping GDP alive, that's masking what's happening.
The tech sector.
The tech sector, and
Which
specifically the AI boom and the data center build-outs.
Which makes me kind of nervous because there's a lot of like uncertainties there.
Just look at tech in the stock market. If you look at tech in the stock market in the last few months, it's getting pummeled.
So we're looking at maybe some like very uncertain times and maybe some huge challenges in 2026.
We are looking at that, and I believe that's part of our punchline as to why you should be considering buying or investing now, because the Fed is going to change their tune, and we're going to explain that to everyone. So the 1.4% GDP is a lie. The consumer is actually spending at 2.4%. The tech sector is on fire, but the danger is it's all concentrated in AI. And the Fed sees this resilience in GDP, but it's the tech market just spending, while the job market is literally dying. So the Fed is headed towards this rate trap. And let's take a look at over 800,000 jobs that just disappeared. They were taken from the records. Just crazy.
So how is the labor market being stagnant a buying signal for real estate?
The BLS revised the 2025 job gains down 862,000. So that means in 2025, the United States averaged just 15,000 jobs a month. That is abysmal. What this means is it means the break-even rate. The break-even rate is you have to produce a certain number of jobs to keep the economy going. The break-even rate has now plummeted to between 32,000 to 82,000 jobs lower due to migration. So historically, we needed 100,000 to 150,000 jobs. And I said migration, I meant immigration. We're not in a crash, but we're in this like low fire stalemate where in 2025, we only added 181,000 jobs. That's massively fewer than the 1.46 million. So that's over 1.2 million more that were added in 2024. So the economy is clearly freaking slowing while the government's like, oh, GDP's good, we're all doing fine. AI's over here like, hey, we're throwing a party, while the consumer's over here going, crap, boys, I can't afford beer. Like, is this BYOB? I can't go to the party with you. The reality is that these job gains, this massive revision down, makes 2025 the weakest non-recession year in job growth since 2003. That's over 20 years.
Wow.
So see how we're painting the picture that the Fed is missing part of this boat, and then this is going to create this opportunity. So this follows the previous down revision for the previous year of 911,000 jobs. So the BLS obviously sucks at collecting data when they're literally writing off almost 1 million jobs 2 years in a row. Do you feel the labor market is strong just like the headlines say? Or do you think it's stagnant like the data shows? What's your feeling? Like, drop that in the comments. What are you seeing out there? Because this stagnant jobs means the Fed has to be really careful.
I have a question for you.
Yeah.
Definitely there's not as many people to fill the jobs, or there's not as much hiring, but that could also be the companies. This doesn't make it better, but the companies can't hire, right? It's not just that they don't have people to hire. They're just slowing down their hiring because there's companies like Amazon letting people go. But is that resulting in a higher pay for people? Or is people's salaries going up?
That's a really good question.
Isn't that one of the
Yes.
goals of slowing down immigration? Or in the case of our border, supposedly there's zero illegal immigration happening. So it means whoever is working
Yes.
is getting paid more. Because I've heard that as well.
Yeah. So real world wages are growing, and real world wages grew faster than inflation in the United States. So you are correct. So the people who were employed made a little bit more money, and some of those great and talented people or in-demand people got raises during the process. Across the board, they made higher than inflation wages. The problem is inflation was so big that wages haven't kept up, so people are feeling pinched. And with this hiring like near zero, the Fed can't keep rates at 3.75 forever. They're in a delicate balance. And in this exact moment, the smart money is like, ooh, wait a second. It's the continuation of deal season, and it's time to go shopping. The real estate market, is it stagnant? Is it declining? Or is it crashing? So for you as an investor or a homeowner, the stagnant labor market is a double-edged sword. So I want to give you an upside and a downside for you to be thinking about. The downside is that low job growth leads to low consumer confidence and real estate hesitancy. Like we talked about earlier, Anything that's uncertain causes the consumer on the real estate side from an emotional perspective to just slow down. See, if people aren't getting new jobs and if they're not getting a tons of raises, they're not ready to go buy homes at historically high prices and high interest rates. Now, the upside, though, is that this stagnation is the primary reason that there's pressure forcing the Federal Reserve to consider more rate cuts. Governor Waller has already noted that because the labor market is weak, the Fed may need to look through this tariff inflation and cut rates to prevent a full-blown labor market deterioration. Well, if you just lost 1 million jobs, almost 1 million 2 years in a row, do you think the labor market's deteriorating? The Fed's waiting too long. They're too late Fed. The labor market isn't strong. It's on freaking life support, and I believe the Federal Reserve knows this. And they're caught between a rock, which is tariff inflation, and a hard place, which is the low to zero job growth. While the official numbers say inflation is still a problem, there's a secret data set that the top hedge funds are using, that we're looking at, our subscribers are going to look at, to show that inflation's already dead. We already won the battle. So if we're right, the Fed is going to be forced into a massive U-turn on their policy. And this is where we need to look at the truth gap between the government data, CPI, and trueflation.
You said earlier that you think the Fed is a little bit late.
Late to the party.
Yeah, right. So they're all about data dependent,
Yeah.
but do you think they're maybe blind to
Yes.
the real data?
Yes.
And tell me more about that.
I think the Fed is literally flying blind, and there's a massive truth gap in inflation. The pivot point in this entire real estate transmission chain is inflation. This is what I want you to watch. This is how you'll see the market change. If the Fed thinks that inflation is high, rates stay high, and buyers' purchasing power dies. But right now, there's this truth gap between the government's lagging data and the real-time economy. So the Fed's official metrics are like looking in the rearview mirror through a telescope. Like it's literally that bad. And I'm going to explain. CPI for January showed 2.4%. The shelter lag, which is over a third of CPI. That lag approach shows what happens to rents and owner equivalent rents over the last 6 to 12 months, not what is happening today. PCE, which is the Fed's North Star, and their thing they're trying to get to about 2%, that's hovering around 3% yearly right now, which has Fed officials like Lisa Cook and Michael Barr sounding the alarm and saying, well, maybe we need some rate increases. The reality, though, is the Federal Reserve is still calling people. Do you have a landline?
No, I don't.
Oh.
I haven't had one in a long time.
Mutually, bro, you got a landline?
Absolutely not.
So we don't have a landline.
My parents do.
Yeah. So they're calling people on the landline. The number of people responding to the survey has gone down by almost 40% in the last 2 years because nobody answers their landline. Wait a second. For the largest economy in the world, the economy with the most money, we couldn't use just real-time data to figure it out. We couldn't get there quicker. So this is why the Fed is looking at lagging data. We just told you that fourth quarter for the majority of the United States and for here in the Seattle metro showed home prices going down. As a landlord who has a bunch of rentals, my rent prices aren't going up. Most of them are flat to slightly down right now.
Really? Your rent?
Yeah, for everyone's rents. Because I know investors all throughout the United States, everyone's rents are flat or slightly down. Rents aren't going up, but CPI data is saying home prices are going up and rents are going up. So it brings CPI and PCE in hot.
And you need to lower rates before this happens, right?
You need to lower rates before the job market breaks. Once the job market breaks, the Fed is too far behind and they won't be able to goose the economy. So think of it, you're out camping. If there's no coals left and you throw a piece of wood on it, the fire's not going to keep going because the fire is already out. If the fire to the economy goes out and we're not hiring people, and for 2 years in a row, 911,000 less, 862,000 less jobs were just written off by the Bureau of Labor Statistics, that's showing you that unemployment and the labor economy is massively slowing down. And just ask a consumer, do you feel pinched? Do you feel more secure? Trueflation, the real-time disruptor, uses 13 million real-time data points. The divergence in this data, Trueflation is currently showing between 0.7 to 1%. And this morning, it showed CPI data measured with real-time data instead of the Federal Reserve's lagging data at 0.95. And the government's target is 2%. What I'm hoping happens with the new Federal Reserve chairman, we go and update some of this real-time data. The U.S. economy is moving too fast. So this official look is showing the data being too hot and too high. So if we've already beaten inflation and the Fed keeps the policy restrictive, you're restricting rates for something you already beat. Lastly, you've got this tariff wildcard. This is part of the transmission chain in this, point. It gets messy because of the 15% pivot. So now price shocks, economists are warning there could be a 0.5% to a 1% add back into inflation because of tariffs. So once again, this is why I don't like tariffs. The look-through scenario that Governor Waller suggested might be able to look through this as a one-time spike, but it may not change long-term expectations. So if the Fed ignores the real-time cooling data, aka Trueflation, and only reacts to things like the tariff spikes and the lagging housing inflation data, they could actually trigger us into a deep recession. So the Fed's basically they're driving a Ferrari. They're staring in the rearview mirror with like one hand up, all periscope, and they it's 3% inflation while the real data's saying we're, 0.95.
So let me walk us through this whole thing, and you tell me if I'm thinking about this right. Trump's original tariffs in the January of 2025 really kind of spooked the market, right?
Correct.
And we are working through kind of the negotiations. But that eventually did drive prices up because it costs more, okay?
That was shown by all of those studies.
Yeah, and that was all throughout basically 2025.
Correct.
So inflation did go up for goods and
Correct.
services. That price going up ultimately hurt consumers, which also hurt their buying power,
Yes.
which hurts businesses and the labor market because you can't hire as many people, or maybe you have to let people go.
100%.
We're now at the fourth quarter where I was telling you, I saw prices going up steadily all throughout 2025, but it hit a peak. When I say it hit a peak, where I was like, whoa, it's crazy. Like the tariffs I hear was in, funny enough, November and December. But there's certain things that went down, like you said, home prices, maybe other prices.
Doritos.
Doritos, yeah. So if we're having new Trump tariffs, right, because of the 10 to 15% that he's implementing, but we're already on a downward spiral, it could create another bump, but ultimately down the road, it could really hurt us. So we could see a even bigger cliff.
And that's why that's another example of why the Fed is behind. Once the Fed realizes that they've overshot their target, they're going to be forced, brutally forced to cut rates. The herd comes rushing back into real estate, and you don't have to wait for them. We're going to talk about the mortgage spread and why interest rates are falling without the Fed already. And Benji was asking some great questions. Are you seeing prices drop in your area, in your town, in your city, at the grocery store, at the gas pump? Let us know in the comments. I want to see if your local area is matching what Trueflation is saying. What prices have you seen, if any, come down? And I also want you to remember, inflation is measuring the rate of change of the prices, not the absolute price. Consumers want prices to go back to where they were in 2020.
But it's not going to.
It's never going to. We printed too much money. when prices increase like that, that is permanent. Inflation is measuring how quickly they're going up. Are they slowing down going up is what inflation is measuring.
But that's not completely true, even though this is anecdotal, because Doritos did go down.
Doritos did go down. You're absolutely correct.
So when a business gets hurt, right,
Yes.
because people aren't buying the product, they have to change the price. So couldn't you argue that prices could go down, get lowered on the market?
Prices could go down and get lowered, but if we go into actual deflation because the consumer feels pinched and they want things to go back,
that's really bad.
actual deflation kicks us into a recession just like the great financial crisis. That was actual deflation. Okay?
Yeah.
Slowing down of price increases is just inflation slowing down. You don't want actual deflation.
Yeah, you want to avoid that. Like as bad as runaway inflation.
As unaffordable as things are and as pinched as people are, if we get actual deflation, you could see us go into a nasty, nasty recession.
All right, let's talk now about the Federal Reserve and interest rates, because of course the number one thing that affects home prices is mortgage rates, and that's affected by what the Federal Reserve does in terms of the interest rates they set. What is happening? Because one of the big things I'll ask, I don't know if you're going to talk about it, is aren't we going to get a new chairman here?
Yes.
There's going to be no more Papa Powell.
Papa Powell's gone.
What's the new guy and his new nickname?
Trump's boy.
We need to sell those Papa Powell shirts.
This is the engine room of the transmission chain of what we've been talking about. The Federal Reserve had their Federal Open Market Committee meeting. It's known as the FOMC meeting. And they locked in a high-stakes debate that really dictates mortgage rates for the rest of the year. And while the higher for longer narrative is still being pushed by some, you're seeing division among the Federal Reserve where some of these internal divides are becoming impossible to ignore. So the Fed met in January. They held rates steady at the 3.5 to 3.75. The hawks, which were several Fed officials, were concerned that inflation had stalled above 2%, and interest rate hikes might actually need to be on the table. The dissenters, there was 2, so 10 voted for it, 2 dissented. They explicitly favored immediate rate cuts. The look-through camp, which is Governor Waller, he's kind of leading that growing faction that believes the Fed should look through these temporary price spikes caused by the inflation and focus on the deteriorating labor market. They also said in their meeting notes, we're going back to our two-sided mandate, labor and inflation. Come on, guys, we already beat inflation. Just focus on freaking labor. The consumer is pinched. You're going to wait too long. How do you know they're going to wait too long? Because when prices were massively shooting up, what did they tell us inflation was? They said inflation was transitory. So they're going to do the same thing again and wait too long and cause the pain to the consumer that is not necessary. Our economy was humming right along. Let the economy cook.
But won't that change when, as you said it, I didn't say it, Trump's boy gets in there?
Yes and no. So Trump's boy can't immediately come in, the new Kevin, and cut rates because he's only one person. You've got to get all of the governors to vote for that. He just gets to be the cheerleader, the champion, the coach. You still got to get the rest of the board on. So he'll be pro rate cuts, but I mean, you only had 2 out of the 10 that wanted to cut in January. So you need, 5 more, 4 more to be able to make this happen. So when are the next 1 to 2 rate cuts coming? The market has a consensus basis that we're going to receive 2 more 25 basis point cuts. A 25 basis point cuts is 0.25%. Where the market's pricing in right now is currently in June and September. This data dependency, though, Papa Powell has emphasized while the risk may have diminished and growth has improved, the challenging labor market makes the March policy meeting highly data dependent. But this is why rates are currently going down. Okay, so now we're flipping over to the good news and talking about the opportunity. I need you to see the whole playing field. Now we're flipping.
Because I saw a post from a friend of ours, Thatch, that was like 5.6%.
Bingo.
That's crazy.
So you were able, and actually, I think I put it in here in the notes. Today's rate was 5.99 for your standard 30-year fixed, and then I think the ARM was 5.23. So if he had a lender that he knew about or someone was running a special, they could have been providing that rate at a slightly discount, or you had to buy a little bit of discount points. But moral of the story, with just a little bit of discount points, you're in the mid fives right now. That's the moral of the story. And why is that happening? It's because of the mortgage spread miracle that we're seeing. So the Fed didn't cut rates, but debt has actually been getting cheaper. It's because there's a spread. The 10-year treasury is what bases debt for almost everything we take in as consumers. Car loans, student debt, home equity lines of credit, business lines of credit, and the 30-year fixed mortgage. And right now, the spread has narrowed to 1.9. So if you look at the 10-year treasury, let's just call it 4.1. You add in 1.9, that gets you about 6%. Once again, they were 5.99 this morning. They're returning to that historical normal, and the historical norm is between 1.5% to 2%, and the kind of the median number in there is 1.8. So we're almost right down that. So that spread collapsing pulled us from like 6.25 down to the basically right at just below 6. Understand that during the chaos of 2023, it ballooned to 3.1. Why would the bank stack 3.1 on top of the rate? They do it for the risk. This is their risk premium. That's what the spread is. That's where they make the money. And they were worried that everyone was going to refinance really quick. Understand, when a bank gives you a loan, they actually don't make money on the origination of the loan. They make money on the servicing of the loan. And that doesn't generally happen until like 24 to sometimes 36 months in. So they don't make any money for the first 2 years. So they had to jack up the rate because of that uncertainty, because they knew all those loans were going to get refinanced.
From the mortgage lenders, right?
Correct.
From the banks right now, is there more uncertainty or less uncertainty?
Less uncertainty. This is why the mortgage spread graph is going down.
Less uncertainty.
Less uncertainty.
Even though we just got through like almost an hour of talking about how there's all kinds of like challenges coming up.
Those are challenges, but relative to where we were in 2022 and 2023, from a banking perspective, because the Fed has started lowering rates and inflation has started coming down, because bankers think real long term. Bankers aren't short-term day traders. You know, they're not crypto bros. They think long-term. So as the inflation number came down, and these spreads naturally came down themselves. And so as inflation pinches, the spread is pinching. So remember when we talked about in another episode how Trump had proposed about Fannie Mae and Freddie Mac going and buying mortgage-backed securities to pull down interest rates? That's another part of the key reason that this is narrowing. That's one other factor that pulled these yields down. And the stock market has been getting massively beat up over the AI trade. So you saw a karaoke company, this company that used to be a karaoke startup that only makes like a few $100,000 a year, said something. It spread like the contagion. It started the AI trade and it just went like wildfire.
Just recently?
Just recently.
Okay.
So you saw all of these tech companies in the last literally couple of months, few months, drop 10, 20, 30%. Go look at Microsoft. Go look at Amazon. Go look at Tesla. Everyone is pulled from their all-time highs back into the long-term moving averages of like the 100 and the 200-day simple moving average. Now understand, when the stock market gets beat up like that, money moves. Where does it move? Money moves to safety. What is a bond? So the stock market gets beat up. Ooh, they move over into bonds for safety and security. As people buy more bonds, the yield goes down, which causes mortgage rates to go down.
Because the banks literally have more cash in the coffers, making it more healthy, making them more confident to lend.
Sort of. That's one of the underlying things that's happening there. It's actually like larger than that. This is this is billions, maybe trillions of dollars in rotation. As the stock market collapses, investors get scared, and then they move to the safety of bonds. And as they move to the safety of bonds, that big chunk of money coming over, purchasing the bonds, more demand pushes the interest rates down.
Long story short, interest rates about to come down.
Interest rates have already come down,
God.
and I believe they're getting ready to come down more. So once the Federal Reserve cuts, you could see mortgage rates at 5.5 by the end of the year. And the Fed is split. The bond market's already making its move. Mortgage spreads are compressing. And while the national market feels sluggish, something in our backyard is happening. Washington State's, our inventory went up 26%. If you're waiting for the Fed to make their move, you're going to miss it. You're going to miss this inventory peak. And the final link in our real estate chain is this opportunity inside of real estate. Understand, and we've said this before, but it's really worth reiterating right now. Listeners, if rates go down 1%, the average buyer now qualifies for 10% more in purchasing power. So if they go down 0.5%, it allows a buyer to purchase 5% more home or have 5% less in payments. That is the real estate market dynamic that creates instant activity. If you're in the market to buy or sell this year, type ready into the comments. I want to see how many of you are thinking about jumping in before this June rate cut hits. And you can also hit us up at resg.com. We're here to help for anything in Washington State.
All right, so we talked a lot about tariffs, about the job markets, interest rates.
Yep.
Obviously, this all started with us saying that home prices have been coming down. And the question is, will it come down? And why that's important is because people might want to buy real estate, right? Some people might need to sell real estate or invest in the market. What's your strategic advice for people moving forward, and what's going on in the market that people need to know about?
Like we said, the final link in the chain is, what's happening. The national level is the market's kind of in a wait and see mode. Builder confidence, the NAHB housing market index fell to 36 in February, which is well below the break even of 50. So in other words, builder confidence right now is very low. Building permits were down 4% in 2025 to about 1.43 million units versus what they were in 2024. Sales were sluggish. So NAR, National Association of Realtors, just released their seasonally adjusted existing home sales report. The existing home sales report for January 2026 was the run rate was 3.91 million. 4 million is like the great financial crisis. 3.91 million is like 1995. So I mean, this is slow.
Crazy. And population did have a little bit of a pause.
Well, it did, but our population relative to the great financial crisis, or even relative to the 90s,
True.
I mean, we got millions and millions of more
So
people
people
here.
are literally graduating high school, graduating college, moving on with their life. But we have the same inventory growth. I even say
we
that.
have the same number of sales that we did
Sales.
on national level in 95, and about the same that we did during the great financial crisis here locally.
Building growth. I wonder what that data is. Like building, how many units we built in 1995 compared to in like 2025. You think it's pretty close?
In the late 90s, I think we were doing a few 100,000. What happened was in the early 2000s, we had that massive construction boom. That's where we first started to crest into the millions again, just like we did in the 70s and 80s. So actually that part of the 90s was a low in construction. And then, of course, during the great financial crisis, that crashed again. That's what got us the 4 million units behind.
How many units are we building per year right now, you think?
1.4, 1.5. We're building, depending on the measurement, we're building somewhere between 600 to 1.1 million units less than we need every year right now. and we're currently about 6 million units behind.
So there's gonna be a lot of like angry people living at home with their parents still.
In their basement. Mom, bring me a Hot Pocket.
Those burn your mouth, by the way.
But that's your opportunity because, so I want to get through a little bit more, but I want you to keep that listener, subscriber in your head. That's the opportunity. That missing inventory is the opportunity. Nationally, we're at January. The median home sales price was $396,800. It was only up 0.9. That's not even keeping up with inflation. Case-Shiller just released their home price index. And Case-Shiller finishing December 2025 showed that national home prices grew 1.3% for the whole year. That marks the weakest annual gain since 2011. Now, when we talk about national home prices, realize inside of the nation, there are parts that are going to be up higher than that, and there are going to be parts that are going to be much lower than that because real estate is a really local thing. So we've got this, but wages grew faster. Therefore, homes became more affordable, but just barely. And we've got a confidence crisis. The consumer confidence is at historic lows with expectations staying low levels because they're associated with recession risks and tariffs, and this uncertainty still isn't gone. So what's happening then at a local level? Buyers have leverage. And the national market feels stuck, and Washington State, we're moving into a different cycle. So inventory shot up. We saw price softening. Washington State median sales price for residential and condos was $595,000, which was down for January, 3.25%. Okay. I will tell you the condos really beat that up. That was a worse part of that. That's why that number looks so low. When I look at just the residential for King County, the median was 855, up 0.6%, and 33 days on market. But see, if January on a rolling 12 is only up 0.6 and inflation is 2.5, it means home prices didn't even keep up with inflation. Snohomish County was $725,000 on the rolling 12. It was down 1.4% with 32 days on the market. What this is showing you is what we were talking about. Fourth quarter was definitely slowing down. The start of this year is slower than last year. So in the Seattle Metro, to start 2026 off, we've seen higher days on market. In other words, it's taking a little bit longer to sell. We've seen inventory grow. We've seen price reductions increase. We've seen the number of quick sales less than 2025, and the number of closed sales and pendings less than 2025. So the market has started out slightly slower in 2026 than we did in 2025. But, this is the big but, we just explained to you that the Federal Reserve is going to have to U-turn. They're going to have to save the employment market to save the economy. So they're going to have to give us those rate cuts. And when they give us those rate cuts, what's going to happen is you're probably going to see like 5.5%. And then as you see 5.5% on the 30-year, which means with a slight buy down, you could be at 5, you'll see that market demand in the latter part of the spring market light on fire. So I'm going to give you some real examples. We just got into a bidding war last week. We also put a great listing on the market in Lake Stevens. It had 4 people come by over the weekend, 4 people on the open house on Saturday, 4 on the open house on Sunday. Price, well, no offer yet. Another one in Federal Way, same thing, good activity, no offer yet. So you're seeing some immediate bidding wars, and you're seeing some that are getting good activity and no offers yet. So the buyer still has some negotiation, but realize some just are immediately poof, just flying off the shelf. And each area is a little bit different. So the closer you get to Bellevue, the more demand there is. The more that you're looking at something that's really unique, waterfront, the more demand there is. The more cookie cutter there is, the less demand there is, unless that school district just doesn't have other things available inside of it. What this means is that buyers and investors should be acting today, before the Federal Reserve steps in and cuts rates. So the smart money is already making offers now. Our buyers are getting pre-approved now. For some of our sellers that don't need to sell, we've told them, hey, just wait for a little bit. Like, put it on in late March or April or May. Let the market heat up a little bit more. For the people who need to get a deal or want to get a deal, they need to start looking right now. It's also interesting too, because the weather has started getting nicer. My investors are even waking up. So this week, and it's Tuesday when we're recording this. So yesterday, I got 5 different phone calls from investors, and they literally said, hey, Anton, checking in. What are we buying? Got any deals? And I said, bro, for you, I always got deals. What do you what you want, what you need? We got the deal for you. And
you're like the trench coat.
Exactly. You open the trench coat. You're like, pick a
I got
watch.
a duplex right here. I got an ADU. I got some. Do you want commercial? It's real good prices right now.
Yeah.
Downtown Seattle.
Exactly.
Clearance.
Exactly. But that's the opportunity. And the market is in a state of flux. The wild card is, so how to master this? I need you to really pay attention to what happens with trade policy, what happens with tariffs. Then next, I need you to look at the Federal Reserve and inflation numbers. And then next, I need you to watch unemployment. If unemployment stays low and we see that really weak job growth, 32,000, 40,000 jobs a month, the Fed is more likely to cut, which will cause us to light on fire faster. But inventory is building up right now. So don't wait for the herd. Don't wait for everything to stabilize. You need to strike slightly ahead of this one, because everyone else will always wait for the certainty, which will just make the market more expensive. The data doesn't lie. Washington State, most of it right now, is currently in a disguised buyer's market. I got my trench coat on and I got deals hiding in the side. And we basically went from what did the Supreme Court do to what's happening here in the Seattle Metro. And people think like, oh, the national stuff doesn't affect us. It affects us. People think the local stuff doesn't affect us. The income tax, if passed, will affect us. 106,000 people signed in con before the testimony in the House Finance Committee today. The most in history of any bill, beating what just happened in the Senate. Obviously, Washingtonians don't want an income tax. And obviously, none of the politicians are listening and should be absolutely voted out because of it. But at the same time, I don't want you to let these headlines scare you away from wealth building opportunities.
Anton, so ultimately, the real question is, will home prices keep dropping, and how long will they keep dropping in Washington State?
I think Washington State and nationally, they're basically both going to do the same thing. Of course, we know the Seattle Metro better. What we're looking at is if the labor market's breaking, if inflation is coming down, and if the Fed starts cutting rates, then home prices will rise. Home prices will go the other direction because you're going to see more demand kick in. That's why we're saying to people, hey, if this is happening before the Fed U-turns, buy now or consider buying now. None of this is perfect. You're never going to buy the bottom. But what you need to do is you need to be prepared, because it's obvious in the data that the Fed is going to have to change their tune. And it's obvious in our conversations that Papa Powell's getting replaced, and you got Kevin coming in, and Kevin's going to try to change everything. That's what Trump wants. He wants lower rates so that all of the politicians can get reelected for the midterms. So will home prices, keep dropping? Probably not. This was probably the end of that. Now, having said that, if we go to war or something fundamentally changes or a black swan event, absolutely they're going to keep dropping and expect them to go further. But right now, what it looks like is you're nearing the end of that window, which means the opportunity is closing. See, I'm always a buyer. I'm an investor at heart. So I'm always looking to buy when there's a good time to buy an opportunity, not when everyone wants to buy because it feels great. If you found this breakout helpful, hit that subscribe button, share this with a friend who's sitting on the fence, and we'll see you in the next one.